Welcome to ACCA F7 question. In this question, we are looking at a question which came in June 2016, Zanda Company. This is a consolidation question. Like in most consolidated questions, we first look at the requirement. The requirement in this case is the computation of goodwill, retained earnings, and non-controlling interest. Again, like in most consolidated questions, the first thing we do is to ascertain the reporting date. In this case, the 1st March 2016. This gives us a reporting period of 1st April 2015 to 31st March 2016. Next is to ascertain the date of acquisition of the subsidiary. In this case, 1st October 2015. October 2015 will be there, giving us a period of 6 months pre-acquisition and 6 months post-acquisition. Goodwill computation. We first start with the consideration. The consideration being the amount paid for the acquisition of the shares in the subsidiary. It was a share exchange of 1 new share in Z for every 2 shares in M. M had 9,000 shares, of which we acquired 60%. In exchange for our shares, which are valued at $3 each. So 9,000 shares, we acquired 60% in exchange of 1 for 2 for each of our shares valued at $3 to give us a total of 8,100. Then the deferred consideration of a further $0.54 per acquired share to be paid on 31st of September 2016. Since this is deferred consideration, we'll have to discount it at the cost of capital of 8% given. So 9,000 shares, acquired 60% at 0.54 deferred. To give us a total of 2,700. Next is the non-controlling interest. We acquired 60%, therefore 40% belongs to the NCI. The value of the NCI is given in note 2, 150. Give us a total of 5,400. Giving us a total of 16,200. Name say less fair value of net assets acquired. This was split into share capital, of 9,000, pre-acquisition reserves. These are the reserves which the subsidiary had before we acquired the 60%. We have brought forward of 8.6 and half of the loss of 3 million. Then we bring in our fair value adjustments. At the date of acquisition, Z conducted fair value exercise of M company's net assets, which were equal to their carrying amount, with the exception of an item of plant, which had a fair value of 2.5 million below its carrying amount. This plant had a remaining useful life of 30 months at 1st October 2015. Since the fair value was below the carrying amount, this amount will be subtracted from the net assets. There's